So we're going to wait a minute or two for the folks to join before we start. All right, so we're going to get started. So good morning, everyone. Thank you for joining us in this presentation titled Tax Advantages of an IRS 1031 Like-Kind Exchange in Real Estate Transactions. My name is Rod Alab. I'm president of the Real Estate Committee at the Texas Argentina Chamber of Commerce, also managing partner of Houston Equity Partners. It's a Houston-based real estate investment company specialized in industrial, retail, and self-storage assets. So before we begin, a word on the Chamber. The Chamber is a non-for-profit organization with a mission of fostering commercial development between Texas and Argentina by facilitating relationships between companies, investors, governments, and business organizations. The Chamber is comprised of 5 chapters and 5 business sector committees. 5 chapters are in Houston, Dallas, Austin, in Texas, and Neuquén and Buenos Aires in Argentina. The business sector committees are energy, health, food and beverage, innovation and technology, and real estate. Anyone that wants to become a member can do so by visiting our website at argentinatexas.org. So with that out of the way, today's presentation will cover the basic concepts of a 1031 like-kind exchange in real estate transactions. We'll cover how a 1031 exchange works, so the mechanics, the keys for success and pitfalls to avoid. We'll cover also some advanced techniques and options, the long-term benefits, and finally, the role of a qualified intermediary. For this purpose, we have Ken Palman, founder of the Exchange Resource Group, joining us today. The Exchange Resource Group is a group specialized in assisting clients who are transacting in 1031 qualified properties located anywhere in the U.S. soil. Ken has over 10 years of experience as a qualified intermediary for 1031 exchanges and has been a certified exchange specialist since 2016. With that, welcome, Ken. Good morning.
Good morning. Thank you, Rod. Appreciate you having me, and thank you all for joining for this webinar. We'll spend about 45 minutes or so going through the presentation. I understand it will be available to you to view outside of the presentation as well. And hopefully we'll have a little time for question and answer at the end of the presentation. Without further ado, let's begin. Rod mentioned the CES behind my name, standing for Certified Exchange Specialist. That's the only designation in the world of 1031 exchange. It means I took a course of study and passed a comprehensive exam in order to get that designation. And I've been on that council for about 5 years now. Its goal is to promote 1031 education and highest ethics for intermediaries around the country. My firm, Exchange Resource Group, is based in the Denver, Colorado area. I am in Colorado. I have a person in Texas, another in Florida, another in Arizona. We do assist clients anywhere in the country with properties anywhere in the country involved in their 1031 exchanges. You can see my contact information there. Always welcome to give me a call if you need some help or have a question. If you can't reach me, welcome to call our corporate office as well. That number listed below. Let's begin. So the big picture of Section 1031. It allows any U.S. taxpayer, meaning different types of taxpayers, individuals, families, trusts, LLCs, S corps, etc., to participate and realize 1031 tax deferral benefits when transacting in real estate. We like to say that 1031 allows a taxpayer to increase their wealth building velocity. So perhaps instead of 5% appreciation of wealth with 1031 exchange, maybe that increases to 8% or 10%. And we'll talk more about how that is accomplished. 1031 allows for flexibility in geography, meaning I can sell a property in Colorado and I can buy a property in Texas. In types of properties, I can sell a condo and buy a commercial property or a piece of land or oil and gas rights, also known as mineral rights. Quantity of properties, I can sell one and buy multiple, or I can sell multiple and buy one. Ownership structure, I can move from owning a property I'm selling in my name to owning replacement property in the name of an LLC under certain conditions. Value of properties, I can go from a high value to many lower value, or I can go from a high value to one low value property and receive either some debt relief or some cash, knowing that that portion will be taxable and the amount I reinvest will receive 1031 tax deferral. Debt equity ratios that can also be adjusted during 1031 transactions. So Section 1031 and a like-kind exchange works by changing a taxable event, a sale, essentially, into a non-taxable exchange. And the IRS authorized that back in 1921, originally to help farmers and ranchers so that they could expand livestock herds and lands without suffering a tax penalty in doing so. Since then, it's become much more broad stream and can be used by virtually anyone who is a U.S. taxpayer, has an obligation to the IRS. It serves to incentivize anyone utilizing 1031 to buy real estate and to buy more often and in greater value. Can also assist in a taxpayer looking toward greater cash flow properties or diversifying the types of properties they may hold in their portfolio, potential for appreciation, etc. A recent study done in response to some talk by the Biden administration on eliminating or reducing the benefits or the viability of 1031 shows that 1031 supports nearly 600,000 jobs and generates billions of dollars of revenue each year. To counteract the administration's thought that this is a tax loophole and it causes lower tax revenues for the government, this study by Ling and Petrova, and there have been others done in recent years, show that that's not the case. It actually is an economic driver. So, bit of a recap to the purpose of a 1031, to transform a sale into a non-taxable event, allowing for tax deferral and resulting in greater profitability and or wealth velocity. And this has been the case for 101 years and counting at this point. So getting into the details just a bit more, how does a 1031 exchange work? Well, any taxpayer can establish a 1031 exchange. They just need to do so before their first related closing. Unfortunately, we do hear from clients or prospects too often, maybe once a month still, where they reach out to us and say, I sold a week or two ago, and now I'd like to do a 1031 exchange. And we have to let them know that it is almost certainly too late. The only way it's possible to still do a 1031 would be through a rescission of the closing. And in most cases, that's just not feasible. The title companies or the closing officers feel liability, or they may have already recorded the deed, etc. So they're not comfortable typically rescinding a closing so that a 1031 can be put in place. And the other party would also have to agree, meaning if I sold my property and I later say, oh, I want to do a 1031, the buyer would also have to agree to rescind that closing. So we try to send the message as often as possible. 1031 needs to be in place prior to that first closing. The exchanger most often will sell first and then has a certain amount of time to acquire replacement property of a like-kind nature. And we'll talk a little bit more about what is like-kind. And ultimately, that exchange is reported with the taxpayer's federal return. So if a client is participating in a 1031 exchange this year, on next year's tax return, they or their tax advisor are going to fill out Form 8824, a federal form, goes with their return and tells the IRS computer, hey, ignore that 1099 that this taxpayer submitted. We have an 8824 that gives them tax deferral under 1031. Here's the meat of the presentation today. Key components for a successful 1031. So I'm going to go through these one at a time fairly quickly, but this really encompasses, I would say, most of what you as a potential exchanger might want to know and be aware of. And certainly our role is to be there for you, so that you don't have to remember all of these details. If you can remember the bigger picture items, hopefully you will know when you have a situation that may be a good fit for a 1031 exchange. And then we or another good qualified intermediary firm can step in and take care of the details for you. So moving into those 7 pillars of success in a 1031. First of all, properties must be held for investment. And there's a bit of a quote here from the code, and it actually also includes an intent. So a exchanger must show intent to hold property for productive use in a trade or business or for investment. And that's looking at both the property being sold and the property being acquired in a 1031 exchange. And the code doesn't state how long that holding period is, but 100 years of IRS case law show that the minimum holding period to essentially have no risk for the amount of time it's held is 1 year and a day. And we believe that's because in the IRS's view, that's 2 tax reporting years. If you hold it for 366 days, you've now reported that property for business or investment use in 2 separate tax years. It also means that someone who's flipping properties or who is a dealer developer does not have property that's eligible, because the IRS has determined in case law that in those cases, the property is deemed to be held as inventory, not being held for productive use. So again, it's that intent. So if someone comes in with the intent of, hey, I'm acquiring this house, I'm fixing it up quickly, and I'm selling it, I'm flipping it, that does not meet this requirement. When we have someone who does flip properties ask us about using 1031, we tell them you need to add a step and a period of time where you rent that property, ideally for 1 year and a day. So you acquire, you fix it up, but instead of then selling it or flipping it, you're going to hold it for 1 year and a day as a rental. And after that point, it is 1031 eligible, and you can then sell that property and not have to pay taxes on the gain, and instead be able to use that additional money for new investment. So rental property, always an investment, other than there is that little asterisk there. The exception would be when it's considered an extension of a residence. So for example, I have a child in college. If I bought a rental property for him to live in, I need to charge him fair market consideration, meaning I can charge him a little less rent than maybe the other roommates because he's giving a little more consideration to me. For example, he will tell me if something's wrong with the property. He will meet a repair person to fix something. Maybe he'll do some minor repairs. Maybe he collects rent from the other roommates. So if the other kids pay $600 a month rent, I would say I'm comfortable charging him $500, and $100 is for that other consideration. If I charge him no rent or very little rent, $100 a month, IRS case law would say I'm taking on quite a bit of risk. If they reviewed my 1031 in the future, they would likely determine, wait, Ken, that's not being held for productive use in trade or business or investment. That's being held as an extension of your residence. You're giving your kid a free or close to it place to live. That's the same as him living at home, and therefore that property doesn't qualify. But other than that, rentals always work. Raw land is always an investment. And then there's some maybe what I would call non-traditional types of real estate or real property that are also eligible. These images are meant to represent water rights, oil and gas or mineral rights, and even air rights. We had a client in Boston who had a 2-story building. He sold the air above his building to a neighbor who was building a skyscraper as required by the city in order for that skyscraper to be built. And he took those proceeds from selling the air above his building and bought other qualifying property in a 1031 exchange. Quick example, Phil and Pip, friends of mine from college, love using their names, rented out a duplex for 5 years. Now they found this place on the beach. They want to buy it, rent it out some, use it a little bit themselves, and have an eye on retiring there in some years. Do you think that works based on what we've talked about so far? It sure does. So the duplex they're selling, that meets the requirement, right? They've held it for 5 years as a productive use property, right? It's been an income producing property, not their primary residence. And what they're buying, they're also going to rent out. And after a year and a day, again, they have that right to change the use of that property. They could move into it. They could sell it and pay the tax at some point in the future, or they could do another 1031 exchange and move out of this property and into something else and defer taxes again. This is the first of the 2 timeframes that are stated in Code 1031, the 45-day ID period, which says from the time an exchanger starts a 1031 exchange, they need to do one of 2 things. And that start date is based on the closing date. Okay, so from the date I sell, I have 45 calendar days to do one of 2 things: either acquire what I want to acquire in my 1031 and complete it, or go through a written identification step and turn that into the QI. That's a company like mine, Qualified Intermediary, by midnight on day 45. There are fairly restrictive rules on how many properties I can identify. The 2 most common rules are the 3 property rule that says identify up to 3 properties regardless of their value, and the 200% rule, which says identify as many properties as you like, but now your restriction is 200% of your gross sale price. So if I sell a property, excuse me, just using an easy round number for $1 million, I can identify as many properties as I like, as long as the total market value of all of them does not exceed 200% of my sale price, meaning $2 million. So that could be 4 properties at $500,000. That could be 40 properties at $50,000. I just can't exceed $2 million combined. The timelines are very strict. Only a presidentially declared disaster or a national emergency, along with the IRS's granting of additional time, will allow a taxpayer to have more than 45 days. So it's not something anyone can plan on, right? And that comes with unfortunate situations anyways. We had some relief granted here in Colorado for the fires that occurred right at the end of 2021. There has been some relief in Texas. There was the big freeze a couple years ago. The IRS authorized some timeframe relief for taxpayers during that or because of that situation. Hurricanes will often receive relief, and it's usually done by zip code or county. But again, right, no one entering into a 1031 can plan for that or can expect to have more time. So we just say, hey, you have to plan on a strict 45 days to either buy what you want to buy or turn in the identification in order to receive more time in your 1031. And the other important point here is that the identification becomes locked on day 46. So for those first 45 days, I can change my mind on what I might want to buy. I can think about 3 properties, and as I get closer to day 45, maybe one of them falls out, it's no longer available, or I go take a look at it and it's not what I thought it was. I can substitute in something else. But once I reach day 46, I can no longer amend the properties I've identified, and I can only have a successful 1031 by buying one or more of the properties on my identification as I turned it in on day 45 or before. The quick ID example, Jack and Jill went up the hill and built this quite space age looking rental, let's say. And now they're selling it, this single family rental, for $800,000. They want to identify $2 or $3 million replacement properties. Can they do that? They sure can, because they're within the 3 property rule, right? As long as they don't exceed 3, they can identify properties with as much value as they like. The IRS's concern is not whether they can afford to buy $1 or $2 or $3 million properties. It's just that they did not exceed 3, and therefore they're good under the 3 property rule. They would not be good under the 200% rule, because in this example, they would only have 1.6 million of identification to work with. So they get more flexibility with the 3 property rule. The other time frame in the code is the 180-day exchange period. And it basically says the maximum time frame for an exchange from start to finish is 180 calendar days. And I guess I would also point out that there must be closings within that period. And I'll probably touch on that a little bit later. But essentially, the clock starts with a closing and the exchange ends either with a closing or upon expiration of law. If someone doesn't acquire replacement property, it can end on day 45 if there's not a written ID submitted, or it can end when the taxpayer or the exchanger acquires the last of the properties that they ID'd and wanted to purchase, or finally, it would end on day 180. And if they hadn't bought a property, or maybe they bought one property, had thought about buying a second property, but it didn't work out, so they had some money remaining in their 1031 account, we would be allowed to return that after day 180 to the taxpayer, to our client. So if you're purchasing within the first 45 days, identification is not part of the requirements. If you need more time, which of course is quite common, then the exchanger must be purchasing from among properties that they identified in writing. And again, only a disaster will typically lead to more time than 180 days start to finish. QI requirements. Again, QI is qualified intermediary. A firm like mine, there are others who can be a qualified intermediary besides professional firms. We'll talk about that just a little bit. Another asterisk, the last one in this presentation. The only time a QI is not required for a successful 1031 is in a straight exchange of deeds without other consideration changing hands. For example, if Rod and I each had a piece of property and we decide we want to swap properties, right? He likes my property in Colorado, I like his property in Texas. We think they're valued at about the same amount. So we just swap deeds, no cash changes hands, there's no third parties involved. Technically, we do not need a qualified intermediary. Our guidance, however, would be to say, you may still want a qualified intermediary involved, guys, because 3 years down the road, 5 years down the road, if the IRS happens to pick one of us to review, we have the burden of proof. So we would have to show the IRS we didn't need a qualified intermediary. And for the relatively low cost, a forward exchange with our company where a client is selling first and buying later is typically around $1,000. That's the total cost for a 1031 exchange where there's one sale and one purchase. So relative to most real estate transactions, that fee, is not a huge cost. So we tend to say, hey, not just because we want, your business or another client, but we also want you to have success with your 1031, and if you're audited, to be in good shape and not be worried about how you completed it. The QI must be unrelated and disinterested, basically meaning cannot be an agent of the taxpayer. So your real estate agent, your attorney, your CPA, your employer, your employee, those are all agents and are therefore disqualified from serving in a 1031 exchange as your intermediary. And disinterested, meaning cannot be a direct family member. Parents, kids, siblings are excluded. And then again, I like to hammer this home. The QI must be involved prior to closing on the relinquished property in the case of a forward exchange, or in a reverse exchange, which is another type of 1031. The taxpayer is going to buy first and sell later. Whatever that first closing is, the 1031 has to be set up going into it. Okay, title requirements basically meaning who's on title to the purchase and sale properties. And the IRS requires the same taxpayer to both start and finish a 1031 exchange. So in this regard, we're talking about tax ID number, not so much name. So I'm married and I have an LLC that's a disregarded entity, meaning it does not file its own taxes. It reports through my social. In that case, I can sell as my name, my and my wife's name only, or that LLC, and I could use any of those combinations in a 1031 exchange, meaning my wife and I could sell a property and our LLC could buy a property because the IRS considers us the same taxpayer and the same tax ID number in that case. So it is critical that the same tax ID number or numbers, if it happens to be a partnership where a couple of partners each own X% of a property, they can do one 1031 exchange as long as they plan to reinvest in those same proportions of ownership. They would meet the same taxpayer rule in that case. quick example. Bev is an owner of a rental house, and her and Ben meet and they fall in love, and Bev's thinking, well, I want to add Ben to title, then we're going to sell in a 1031, and then we're going to buy something else and we'll own it together. Sounds like a nice thing, right? But you can probably tell where this is going. Is this a good idea? It is not. And that's because Ben has not held the property as required, right? He didn't hold the property for a year and a day. Maybe he was added to title a month before Bev and Ben sold the property. Okay, the IRS upon review would say, wait a second, Ben only owned that property for a month. So Bev, while you had good intentions, we need to ask you to pay us 50% of the deferral benefit you had filed for, and maybe some fees and penalties on top of that. So we would not suggest that ownership change in close proximity to selling a 1031 property or to buying a 1031 property. Same thing would apply to property purchased, where we would say, Bev, wait a year and a day, then add Ben to title if you want to both own it or put it into an LLC with a different tax ID number, etc. And talk to your tax advisor about it. You know, not only you want to be careful about your 1031, but you want to accidentally trigger a taxable event outside of 1031 when you do that. Number 6, this is an important one and maybe one of the most misunderstood parts of 1031. What is required for reinvestment in a 1031? And we also talk about that in terms of the equal or up rule and a reinvestment goal for full tax deferral. So if someone wants to maximize their 1031 benefits, meaning I want to defer all the taxes I possibly can, then we would say, okay, then you want to hit your reinvestment goal. There's 2 ways to get at that number. When you sell, you either take your cash received line item and debt relieved line item or line items, if there is debt on the property, and add those together. That's your reinvestment goal. The other way to get to that goal is your gross sale price less your closing costs. Either way, you should get to the same number. So for example, if I sell a property for $525,000 gross, and I pay $25,000 in realtor commissions, title fees, 1031 fee, and miscellaneous, my reinvestment goal is that net sale price of $500,000. Again, for a completely non-taxable event. And here's the misconception, that I have to reinvest at least $500,000 or I can't do a 1031 exchange. That's not true. I even had a CPA tell a client that 2 weeks ago. This person called me and said, well, my CPA says I have to reinvest above my net sale price. And I said, you know, I'm sorry, that's wrong information. Happy to talk to your CPA if they'd like. You know, there's a lot of information a typical CPA is trying to keep their arms around, right? And to remember and to apply correctly. So, you know, I don't blame that CPA too much, other than, boy, if they're not certain, they should be reaching out to a qualified intermediary, you know, to make sure they're giving their client good information. So back to this idea of how much do I have to reinvest? Well, there is no requirement. I can reinvest $100,000 if I like. The challenge is I'm not going to get any benefit from my 1031 exchange until I reinvest more than my basis in the old property. Okay, so if I bought the property for $200,000 and I owned it 13 years, depreciation would have taken about half of that value off of the value of my property, and now it's worth $100,000. So the day I sell it, it has basis of $100,000. Well, if I reinvest $100,000 in new property, I have no benefit from my 1031 because I only reinvested to my basis. If I reinvest after selling for $500,000, 300,000, now I've got 200,000 of deferral, okay, 300 down to my basis of 100. I've got a valid 1031 exchange. I got some benefit. However, I will also owe tax on the portion I didn't reinvest, 300 to 500. So I have 200,000 of tax exposure as well. So anyone can decide, do I want to buy equal or up? Do I want to hit that reinvestment goal? Or am I okay not reinvesting to that level and having some tax exposure, but getting some benefit from my 1031? One more reminder, act prior to closing. So the exchange must be established. The exchanger must not receive money from the sale or have the ability to borrow or pledge funds. We use a qualified escrow account, meaning it's a bank account that limits the exchanger's access so that they are in good standing with this IRS requirement. And the other party, so when I'm selling in an exchange, the buyer of my property is going to receive an acknowledgement saying, hey, Ken's participating in a 1031 exchange, please acknowledge. And that is something left over from, I would say, the old days of Code 1031, but still required to this date. A little bit about advanced exchange techniques. We've talked about mostly the most common forward exchange, where the taxpayer sells first, and then they've got up to 180 days to acquire and close on replacement property, right? And that can be 1 for 1, or I can sell 1 and I can buy 3, and they can be in different parts of the country, and they can be different types of properties and different values, et cetera. So keep in mind, like kind is a very broad term. Basically, it has to be real property. And the only gray area that remains around the country for the most part is mobile homes. There are still some states where that's considered personal property. There's a license plate on that mobile home, and the state says this is not real estate, it's treated more like a vehicle. So then the IRS says, okay, that's personal property, not real property. Barring that, as long as it's real property and it's located on US soil, if what is sold is also on US soil, and the intent to hold for business use or investment is met, it's like kind, right? So that definition of like kind is very broad. Other types of exchanges or other options available within 1031 include, which I touched on already, a reverse exchange. I want to buy this property before it gets away. I don't have time to sell what I want to sell before this one might get away. So I'm going to buy first. I either have resources available, or I can get a bridge loan to allow me to buy it. And once I sell, I can repay that bridge loan or a portion of it, et cetera. So that certainly comes into play in some cases for our clients. An improvement or build to suit exchange. I can use some of my sale proceeds to buy a property and other of those proceeds to fix it up. Now, I still only get 180 days start to finish. So one of the most challenging parts of such an exchange is the timing, especially in the age of COVID. Maybe that's starting to get better at this point, but for the past couple of years, it's just taken a lot longer to get anything done. I'm sure many of you have seen and heard about that as well. County offices were closed, they're working remote. So instead of being able to go in and talk to someone about, where are my plans at? How's my zoning coming along? It could be extra days, weeks, months of waiting because there were, government office closures. And then you had people and crews and general contractors either not working or having trouble maintaining crews, or working at reduced capacity because of COVID. And then on top of that, material shortages as well, right? So it has really been a challenge for someone to say, okay, I'm gonna pop the top on this rental and use up half of my sale proceeds in an improvement exchange by day 180. That's been challenging. Hopefully, that timeline will begin to come down a bit, so that's more feasible for more people out there. And one of the other catches to that is the IRS says, hey, you're not supposed to make prepayments with improvement exchange dollars. Whatever you spend, we're showing by case law, needs to be in place on the property by day 180. So you're not supposed to pay your general contractor $100,000 for work they're going to do over the next 12 months. You only get 6 months, and that's from when you bought or sold to start the exchange. So, that time frame's already probably shorter than 6 months, and you're also not supposed to stockpile materials. So let's say it's a commercial building. If you buy 10 HVAC units, they're supposed to be in place on that building by day 180. Now, is the IRS gonna 4 years later have that level of detail to say, well, I see these were sitting on the side of the building? Maybe not, but we would say, hey, this is what the IRS says. You might want to talk to your tax and legal advisors and decide how you want to approach this and the level of risk you're comfortable with. We never want an exchanger to be in a difficult situation if they get that letter asking for an IRS review. Last thing on improvement exchanges, you can also buy raw land and begin to make improvements, and you can use proceeds for professional services as well as the physical work. So architectural services, engineering services, legal costs relating to planning or zoning, that all qualifies. So again, that gives taxpayers some pretty nice flexibility when it comes to what can I do in a 1031 exchange. I've got a project in mind, it may well fit. And then finally, the longer term, maybe bigger picture of 1031s, with proper estate planning, taxes that have been deferred can become permanently forgiven, which is a pretty amazing benefit under our current tax law. And most of the experts, I guess, I've listened to and talked with would say we don't see that changing anytime soon. There has been some talk out of the current administration to do away with step up in basis, for example. And what step up in basis does is it says, okay, Ken, if you have some properties and your kids are your beneficiaries, when you die, your kids get those assets because you've named them as your beneficiary, and they get to receive them at market value on the day you died. So if I've been doing 1031 exchanges for 20 or 30 years, and I keep moving that tax bill into the future, when I sell and buy something new, I've grown my portfolio, or I've grown from, maybe a single family rental to 2 8-plexes over, a couple of decades. I've created a lot of wealth, and my kids get to receive those properties with tax forgiveness. They get them for market value on the day I die. That tax I deferred along the way is forgiven. So that was the talk of the administration, to say, hey, maybe we want to eliminate or restrict that. But most I hear from say that is too central to our tax system and too difficult to change. We don't see that happening. What's more likely to happen, they would say, is the allowance per beneficiary, which is currently at 11 point, I think it's $3 million. So each of my kids can receive 11 point something million dollars of assets before they would be taxed. Okay, that's the estate allowance. There is some talk about reducing that number quite drastically. The latest I saw, and this might be a couple months old, was to take that down to 3 point something million. So still a big number, you could argue. On the other hand, it's a 70-some% reduction. So anyway, under current tax law, it's a pretty awesome benefit to know that, hey, I can defer taxes and build my wealth and my portfolio more rapidly with 1031, and know that when I die some point in the future, my kids can receive those properties and not have a big tax bill hanging over them. Here's an example we like to use to show the power of 1031 over time. So we're going to say, all right, here's two identical properties. One is going to grow without 1031 exchange and the other with 1031 exchange. Let's see what happens. Get that little section symbol to represent the exchanging property or owner. So after 2 years, there's a transaction. The properties sell. And the exchanger has more buying power. They're not needing to set aside 20% of their sale to pay taxes, right? Instead, under 1031, assuming they invest equal or up, they get to reinvest that money that the non-exchanger has to set aside to pay taxes or come up with, take on debt, etc. 5 years, there's another series of transactions, and now the gap in buying power becomes significant. The exchanger has roughly 50% more buying power. After 10 years, another round. I apologize, those numbers are from the 5-year. What it should be showing is that the buying power is now about double in 10 years. And then lastly, these numbers are correct, thankfully. 20 years from when when those two properties first had a transaction, they've made a fourth sale and buy up, and the difference is very obvious, right? You've got 4 times the buying power with 1031 exchange over those transactions. Back to the qualified intermediary and what we do in our industry. Basically 3 things. So we provide information on Section 1031 and how it works in the real world. My company, we try to give as much time to any client or prospect as they need, right? Some are sophisticated, they're very experienced, they don't need much guidance from us at all. Others, maybe it's their first 1031, they're just getting into real estate, they have a lot of questions, that's fine. And we also talk to CPAs, attorneys, realtors, closers, lenders, often about the details of 1031. Figure the more information, more good information that's out there, the better it is for the industry and all of the investors. Secondly, provide paperwork. Some of that's required by Section 1031. Some of it is typical, U.S. business practices, meaning we have an agreement between the exchanger and my firm. We have another agreement between the two of us and the bank that's going to hold their proceeds. And then finally, that documentation is there so that if the IRS ever reviews one of our clients, we've got a clean, concise paper trail. We want that reviewer to open the file and shut it because they couldn't think of anything to ask. So that's our goal with every client. And lastly, we do our best to hold each client's funds in the most secure manner possible. We use a qualified escrow account per exchange. It is signature locked. It's tied to the exchanger's tax ID number, not ours. So if something unfortunate happened to our firm, never has, but if we got sued or we had a bankruptcy issue, our clients' funds are safe with them and they can move forward within their 1031 exchange to completion. And now, Rod, we are to the point of questions and answers. We've got them on the screen here, but I think we thought it'd be good to verbalize them too.
Yeah, thank you, Ken. Really extremely useful and relevant information to know when planning a real estate transaction. I can't stress enough how important it is. Ken has helped us in transactions, no matter how complex or simple. Extremely relevant information. Very competent group. So thank you for the presentation, Ken.
Welcome.
I have time for 2-3 questions. It's very high level. Probably you already covered them during the presentation, but just very high level. The first one, what can a 1031 exchanger expect to pay in taxes with or without a 1031 exchange? Very high level for someone that has never heard about a 1031 exchange.
Yeah, and this is one of the most common questions we get, or we'll get a comment from someone we're talking to, like, well, I'm not sure, I might just pay the 15% capital gains. And while it's true, a 1031 allows for deferral of capital gains, that's only part of the picture. And I think it's important for people to be aware that in a lot of cases, every tax otherwise due can be deferred, both at the federal level and the state level. So it actually is more valuable than just deferring capital gain. So depreciation recapture is typically the first tax taken at the federal level because it's the highest rate. It's a 25% recapture rate. So that depends on how long someone has owned a property that has a structure, right? In that case, there's depreciation allowed each year, basically saying, okay, this property becomes, a little less valuable each year as it gets older. So taxpayer will allow you to depreciate it. However, when you sell it, we want 25% of that benefit back that we let you have over the years you owned it. Then you've got capital gains, typically in the 1031 world, because normal income tends to apply only for short term. And, kind of by definition, when you have to hold a property more than a year and a day, you're past that normal income tax scenario, and you're looking at capital gains. Capital gains are tiered currently at 0, 15, and 20%. There's been some talk again at the federal level of introducing a 5% and possibly an 8% surcharge for ultra high income earners. Wouldn't affect most Americans, but it's targeted at $5 million income earners, and I think the 8% might be at $25 million earners. So in a lot of cases, though, if a client of ours has a job and they're selling real estate that's got a fair amount of gain on it, they may be hitting the 20% capital gains bracket, which kicks in around $420,000 to $450,000, depending on your filing status. So again, my wife and I file joint, $450,000, we go from 15% to 20% capital gains rate. Next, you've got NIIT, net investment income tax, also known as the Medicare or Obamacare surcharge. That's another 3.8% tax at the federal level. So that is added to my depreciation recapture and my capital gains obligations. Then you've got state income tax. Texas, you don't have that. Most states do have a state income tax, and almost all of them allow deferral with the 1031. I know Pennsylvania does not, and I know Georgia will only allow deferral if the reinvestment is also made in Georgia. So if you sell in Georgia and you buy in Arkansas, Georgia wants its state tax paid, even if you're in a 1031 exchange. So we tell clients, hey, you might check with your tax advisor as far as your state income tax and your ability to defer it with a 1031. In Colorado, yes, it's deferrable. So we have a 4.5% state income tax. Someone does a 1031, that tax, along with the federal taxes, can be deferred. And finally, you've got withholding and or transfer taxes that in some cases can be deferred, Again, in Colorado, if you sell here and buy elsewhere, the state wants 2%. They will allow deferral with a 1031 exchange. There are some other local transfer taxes in Colorado that cannot be deferred. So again, good to talk to one's tax advisor going in to know what you're looking at and what your deferral can be with a 1031. So this whole list can potentially be deferred. And then, as I mentioned, through estate planning or a series of 1031s, possibly eliminated. So pretty powerful stuff.
Yeah, very, very important to know. Typically, one associates the 1031 exchange with capital gains only, but it's important to know that you could be also avoiding a bundle of taxes, local and federal state taxes. It's very, very, very good comment there. The other question here is, can an exchange be partially reinvested? If so, what happens with the excess monies?
Yep. So, I tried to cover this, but I think it's a good recap because it is so often misunderstood. And the answer is yes, you can partially reinvest. And if you take cash when you sell, for example, and we have that asked fairly often, we have clients do that fairly often. I remember speaking with a gentleman maybe a month ago who said, I want to pull 50,000 out. I want to renovate my home, my primary residence, with a bit of that money. And our guidance was, you can certainly do that. You can still have a valid 1031 exchange. You're just going to have tax exposure on that 50,000. If you pull cash when you sell, you're creating a taxable event for that amount, but the cash that you leave in the exchange and debt that you relieved and replace, that can all receive a deferral benefit.
Okay. One last one. I think we have one more minute to go. How long does the exchanger has to keep an investment property acquired under the 1031 rules without risk of losing the tax deferral benefits?
Right. And as I said earlier in the presentation, a year and a day is the minimum safe holding period. The exception to that is if there's a related party involved, meaning usually a direct family member, but it could also be a related entity. So if Rod's exchanging and he has a corporation that he's part owner of, he might be a related party to that corporation. And in that case, if he is selling something in a 1031 and buying something as the corporation, they're related parties. Now there's a 2-year hard and fast hold. So that only applies when there's a related party, meaning an entity or a direct family member. That falls under special rules because the IRS is trying to keep taxpayers from playing games, right, and achieving tax avoidance. So it's fine to get tax deferral, right, and do a 1031 the right way. It's not okay to go for tax evasion. And that's why the IRS has that special rule to say, hey, if it's a family member or a related entity, it's a 2-year hold on either side, both what's being sold and what's being purchased, because we're trying to, make it fair for all taxpayers. So thank you.
All right, I think we're just in time. It's noon here in Texas, about to wrap up. Again, thank you, Ken. Extremely useful and relevant information for anyone that is planning a real estate transaction. Just final thank yous. Thank you for Ken, for your group, for volunteering your time. Someone asked in the chat if the presentation will be available. It will be available and replicated in the website of the Chamber of Commerce with your contact information. You can reach out either to Ken or myself in anything that we can assist. Happy to help. Again, one thanks to the audience, everybody that joined and spent time with us for this presentation. And finally, thank you to the staff and the Chamber of Commerce and the sponsors who are making this educational series possible. All right, so with that said, we're done. Thank you very much, Ken, again. Thank you, everyone.
All right, thank you, Rod. Take care, everybody.
Thank you.
Bye-bye.